Welcome to This Week in Money. I'm Phil Mackesy. Today, the biggest mining show in Canada, the PDAC in Toronto. Rick Rule, Louis James, and Sean Brodrick were there. They'll tell us what went on and what happens next to gold and gold miners. We begin with Rick Rule right after this.
He Touched Me, the gospel show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Rick Rule specializes in natural resources. He's founder of Global Resource Investments. It's a member of the Sprott Group of companies. He's online at sprottglobal.com. And he's coming to us from sunny Carlsbad, California. Rick, it's good to have you back on This Week in Money.
Pleasure to be with you. Thank you very much.
You're just back from the PDAC in Toronto, in frigid Toronto. They headline in today's Financial Post saying what you've been saying for a while, junior miners starve for cash. And that kind of is the overwhelming mood at the PDAC this year, is it not?
That's correct. I've been going to the PDAC for about 30 years, and this PDAC ranks in terms of sentiment with market bottoms, historic market bottoms like 91, 92, or 1999, 2000. Now, ironically, for a check writer like me, that means it was the best of all possible times. But certainly the overall mood in the place was very glum. Even the evening's festivities with the drinking had more to do with desperation than celebration, which I take to be a very good sign.
Okay, so the general bottom line here, junior miners, a lot of them are the smaller miners are on life support. The lawyers, the M&A guys waiting patiently on the sidelines. What's going on here with the junior space?
Well, I think what we're doing really is we're unwinding the excesses of what was a 10-year bull market, albeit punctuated by some declines like 2008. The industry did a lot of good things in the last 10 years, and it did a lot of bad things. But one of the things it did was it funded a lot of non-viable companies with non-viable teams simply to earn fees and commissions.
Sure.
And all that has to be, washed out of the system. The truth is that in our industry, like in every other industry, the very worst wounds in the industry are self-inflicted. And so we need to work through this period as a consequence of the excesses that we all participated in over the last 10 years. It's natural and normal.
Rick, take us back 20 years or so to 1992-93 when we were looking basically at the same situation on the venture.
It was very interesting. And what was different, of course, is that the second half, at least the decade of the 80s, was not particularly pleasant for the resource business either. So the companies got marked down after a period of time where they hadn't exactly been force-fed. There were a lot of bargains in place then. There was a lot of professional capitulation. And the financial services industry, then as now, consciously reduced their capacity, their research capacity, and their banking capacity and resources. It was a classical capitulation. And I'm encouraged by the fact, reviewing history, that I paid personally more in capital gains tax in 1996 than my net worth had been in 1991.
Hey, nice.
That will tell you something about, first of all, the bargains that are available in capitulation bottoms, but it will also tell you something about the strength with which the best names in the sector rebound after the bottom has been reached. It's important for people to understand that.
Also important to differentiate between companies with something going on and companies with not much going on. Here's the SNL Metals report released at the PDAC, which kind of sums it up nicely. Junior companies with exceptional projects will be able to finance exploration. Companies with smaller or earlier stage assets, they're the ones that are going to struggle.
Phil, that's absolutely correct. There's been a myriad of problems in the past, but really 3 of them are that the industry financed C teams, that is, people that weren't absolutely first-class explorationists in the last 10 years. The second thing is that what we asked the mining industry to do was give us leverage to commodity prices, which is ironically saying that we asked the mining industry to be marginal. And they certainly complied. They became very, very, very marginal. And the third thing that we did as an industry is that we allowed the total general and administrative take in the exploration sector to get too large. We pulled at random samples last year of 3 different groups of 25 junior miners and looked at 5-year financials, both balance sheets and profit and loss statements. And we saw that the median sub-10 million market cap junior had spent in excess of 50% of total expenditures over 5 years in general and administrative expenditures. And that's shocking. If we were to get a major mining company as a partner in a $1 million exploration program, they might allocate us 12% of that program in general and administrative expense. But the junior mining industry, the publicly traded junior mining industry, spent in excess of 50% of 5-year fundraise on general and administrative expense, and we need to shake that out of the system.
Rick, give me a bird's eye view of where the small cap mining sector goes from here. What happens now?
I think it's bifurcated. I think we have probably already reached the bottom on the best 10 or 15% of the names. If we haven't, maybe we have one more final cataclysmic spasm down before they flatten out and recover. But you're going to start to see three things happen. You are going to see the smart money start to come back in the aftermarkets in these things and pick up things that are selling at 50% discounts to net asset value. You are also going to see amalgamation, both horizontal amalgamation like Lupaka just did, where a couple of juniors put the assets together to lower G&A relative to property expenses, and you're going to see vertical acquisition, where bigger companies take over smaller companies. The other thing that you're going to see, and I truly believe this, is that after 10 years of funding exploration well, we're going to come into a discovery cycle. That's absolutely going to happen. The icing on the cake will come if I'm right in that what we're seeing now in terms of commodity prices is a cyclical decline in a secular bull market. And I think at least with regards to precious metals prices, that is gold, silver, and particularly palladium, the softness that we're seeing in commodity prices is a natural and normal cyclical decline in a secular bull market. However, it's important to note that probably, 70%, maybe 80% of the TSXV is non-viable. Security selection is critical. And my suspicion, in fact, my hope, is that 600 or 700 companies in the sector get delisted as a consequence of not being able to pay the audit fees or not being able to pay the listing fees. It's important that we scrape the non-viable companies out of the system like we did in 1991 and 1992.
Rick, you said that you think this year and next year are going to be absolutely epic for investors. Tell us why you feel that way.
I think that's true. You know, if your listeners were walking through a shopping mall in Toronto, and on the left-hand side there was a shop that said high-quality goods marked off 50%, all goods on sale, and there was a store on the right that said no sales anytime, never a bargain for shoppers, what store would you go into? I mean, this is common sense. Yeah. It's odd that when we buy physical goods, we're relatively intelligent shoppers. But when we buy financial goods, we have more courage at market tops like 2010 than we do at periods in time like this when high-quality goods are on sale. The caveat is that your listeners who intend to play this game have to invest in themselves as well. It can't be something where you go into the market and say, got a hunch, bet a bunch.
Yeah.
You have to study. You have to look at the assets. You have to look at the financials. You have to look at the management team. You have to do the work. Because when the market bifurcates, you don't want to be in the sunk section.
Rick Rule is our guest here on This Week in Money, and let's talk about something that's driving all this. The U.S. dollar ruling. The dollar index hit a 6-month high last week, and you're probably one of the people scratching your head because you're on record here saying the dollar, the worst currency in the world, except for all the others.
Correct, and I think it's proven that. I think, first of all, the U.S. dollar is a floating abstraction, but it is a floating abstraction that happens to be the world's worst currency.
Yeah.
The Japanese, as an example, have decided that they are going to explicitly reduce the value of their currency. I think you're seeing a global war of competitive devaluation. So the dollar looks good relative to the other, as Ian McAvity would say, sort of like the best-looking horse in the glue factory. We have seen dollar strength, first of all, relative to other currencies. But I think the other thing that's important to note, and Ambrose Bierce famously described this 160 years ago, the root word of confidence, which is what makes the dollar strong, is con. And investors do two things that are worthy to note. First, investors' perception of the future is shaped by their experience in the immediate past. And the immediate past has been fairly tranquil. Mm-hmm. The second thing is that most investors, most people generally, search for information in a market that reinforces rather than challenges their paradigms and prejudices. And it is much more pleasant for somebody to look at the last 6 months where things were relatively tranquil, as opposed to looking at periods like 2008, which were anything but tranquil. So my suspicion is that investors would like to believe that the central banks on a global basis will be successful substituting liquidity for solvency, because that's what they're doing. The societies, the political societies that exist in places like Japan, in places like the United States, and places like Western Europe are they're fundamentally insolvent when you look at the on-balance sheet and off-balance sheet promises that they've made. You deal with that in a couple of different ways. You can be honest about it and default, or you can be dishonest about it, and you can inflate away the denominator with regards to those liabilities. That's what I think is going to happen.
Okay.
And if I'm right, the only sort of semi-conventional currency, the only semi-conventional medium of exchange that doesn't have a domestic political constituency that would require devaluation is bullion: gold, silver, platinum, and palladium. And simultaneously, historically, the only generally acceptable mediums of exchange that are simultaneously stores of value, that is not promises to pay, are also bullion. As a consequence of those two facts, my suspicion is, with regards to bullion prices, that they are in a cyclical decline in a secular bull market. I hope that helps.
I guess the guy we should really listen to here is John Malden, our friend John Malden, who says, you want to be successful, simply own things that the central banks can't print.
I really, really, really like that quote. Own stuff they can't print. Malden has it exactly right from my point of view. And regard the current set of circumstances where the dollar, which we're less fond of owning, is expensive, and the bullion, which we're more fond of owning, is cheaper. Sounds like a nice set of circumstances to me. Sounds like a good trade, one we're actively making.
Now, gold weakness expected to continue mostly because of this manufactured confidence in the economy, right?
That would be my suspicion. But you know, these retrenchments are normal and healthy. People forget that. Everybody, I guess, wants the psychological reinforcement of a nonstop bull market.
Yeah.
But that's not the way things work. You will remember, many of your listeners are too young, but you will remember in the mother of all gold bull markets, the 1970 to 1981 bull market, when the gold price ran from $35 an ounce to $850 an ounce. In the middle of that epic market in 1975, the gold market had run from $35 an ounce to $200 an ounce, so a six-bagger. And in the middle of it, it declined from $200 an ounce to $100 an ounce. You had a 50% cyclical decline in a secular bull market. And people who got shaken out in 1975, and tragically there were thousands, missed a 6-year move from $100 an ounce to $850 an ounce. They missed an 8-bagger in 6 years.
We've had, about 7 or 8 pullbacks, Rick, since 2000, I think?
Yeah, I suspect that's right. And, you know, a 10 to 12% pullback is normal and natural.
Rick, now you mentioned that you are bullish on gold and precious metals in general. You mentioned earlier palladium. Why palladium?
Well, I'm particularly bullish on platinum and palladium. And I'm bullish on them for the old-fashioned reasons of supply and demand. This has nothing to do with central banks, although they're certainly part of the play. The first thing to know is that platinum and palladium are, of course, bullion, like gold and silver. Mm-hmm. They have the same historical things. But they have a very, very, very different picture in terms of supply and demand. You know that gold and silver, in terms of supply, much of what has been mined over history is still supply. It sits in bullion. In fact, we do something fairly silly. We pull it out of a hole in the ground called a mine, and we put it in a hole in the ground called a vault. But with platinum and palladium, those above-ground supplies do not exist. Less than 1 year's fabrication demand in platinum and palladium exists as above-ground bullion. Platinum goes out a tailpipe, it goes up a smokestack, or it gets turned into jewelry. Mm-hmm. The supply doesn't exist. So in terms of supply, we're talking about recycling supply, and we're talking about new mine supply. It's very important to understand that first. Secondly, gold and silver are produced ubiquitously around the world in many countries and as a byproduct of producing many other metals. Platinum and palladium are produced in 3 countries, South Africa, Zimbabwe, and Russia. The supplies are extremely constrained. It's important to know that because at today's price points, the global platinum and palladium industry does not earn its cost of capital. In other words, it's non-viable. South Africa by itself produces 70% of the world's platinum and 39% of the world's palladium. It's what really, truly matters. And the South African industry is facing spectacular headwinds. They do not and have not earned their cost of capital for a substantial period of time. That's manifest in the fact that over 6 years, South African supplies have fallen by 19% and continue to fall today. Now, you will have seen in the news the violence racking the South African platinum and palladium mining industry. This is because the workers' wages and working conditions are deplorable. They have to improve, but they can't because the industry doesn't earn its cost of capital. The industry itself estimates that they need between $6 and $8 billion in deferred sustaining capital investments and capital investments to access new parts of the reef, but they can't because they don't earn money, and the market won't give it to them because they don't earn their cost of capital. So you have a set of circumstances where at current platinum and palladium prices, South African, Zimbabwean, and Russian platinum and palladium production is in terminal decline. So the price has to go up. What's more interesting is that the utility afforded by platinum and palladium at these price points is superb. It takes $200 worth of PGMs to give us the air quality that we enjoy as a consequence of catalytic conversion of automobile emissions. And worldwide, there is a press for higher air quality standards, not lower air quality standards. Now, what's interesting is the math. If you doubled the price of platinum and palladium, it would increase the cost component of a car by $200 as opposed to an American median sticker price of $27,000. The demand elasticity within the price points that we're talking about is huge. So what's important is that the price has to go up, and it can go up. I'm just fascinated by this.
Rick Rule is founder of Global Resource Investments. It's a member of the Sprott Group of Companies. He is online at sprottglobal.com. Hey, Rick, always appreciate it. Thank you for taking the time.
Pleasure. Thank you for the audience.
This Week in Money is archived online at talkdigitalnetwork.com.
Louis James is Senior Metals Investment Strategist at Casey Research, and he's Senior Editor of the International Speculator and the Casey Investment Alert. He's online at caseyresearch.com. Louis, good to talk to you again.
Glad to be here.
You are just back from PDAC 2013, huge mining investment show in Toronto. 4 days, 1,000 exhibitors, a lot of folks there. Let's start with Casey Research. What do you guys do at shows like the PDAC? How does it help you stay on top of things?
It is a bit of a show opportunity for us to show off our stuff, but this year the market sentiment was so bearish, it just seemed like maybe not the best use of funds to go and spend a lot of money renting a building, as we sometimes do. We rent the studio across the front door there from the convention center and have some VIP events for our alert subscribers and other people that are important to our franchise. So this year, it just didn't seem like that was worth it. We went low profile, which actually gets to the main reason we go there, and that is that, of course, everybody is there.
Yeah.
It's deal flow. It's getting to talk to management. They've got all their rocks there. They've got all their maps there. They've got all their technical people there. I sat down with one company I had questions about, and they had half the company there. They had metallurgists. They had geologists. They had everybody just waiting to see what question I might ask, and I didn't even talk to them all, but they had them all there in case I had a question, and they wanted to have the right person to have the answer. So that's a good thing. That's really why I go. It's part of my digging for facts, due diligence, and in that place I can cover more stories in less time than just about anywhere else at any other time.
Louis, let's talk about what's going on with sentiment. You mentioned the word bearish. We have a couple of different factors affecting that. One of the things that Rick Rule and I talked about earlier, a newspaper headline in the Financial Post, junior miners starve for cash. This is emerging, I guess, as the big story at this year's PDAC.
Yeah, there are a number of people who've written about that. I have not personally verified the numbers, but I understand that out of the 3,000 or so companies listed on the TSXV, only a couple hundred of them have more than $500,000 in cash. There's just no way that can have a happy ending, and that's going to produce a lot of negative news. And in a way, though, it's something to look for with a positive attitude, because the companies that get washed out need to be washed out. that's a good thing. It narrows the field. It leaves the better companies there. And there's a market psychology, though. If you have a lot of bad news in the market, everybody gets whacked. So what happens is the baby gets thrown out with the bathwater. The good companies get whacked all along with the rest just because the whole market is down. Well, that's already happening. We can see that. Gold retreats. There's headlines about some of the big companies having trouble keeping their costs down, and people are selling gold stocks left and right. Even the companies that are reducing their costs and are reporting record margins. So it's an indiscriminate market. And if there's an event coming that will, A, create increased liquidity, and B, scare the bejesus out of people, for those with the intestinal fortitude to buy when others are selling, it could actually be quite spectacular. Now, if this coincides with a big drop in gold, if the appearance of economic recovery has people thinking, oh, well, we don't need a safe haven so much, and more investors start leaving gold positions, you could actually see a perfect storm. You could see a case where there is almost no bidding whatsoever for these juniors and quality companies, not just the ones that have nothing, but the ones that do have something and even have the money to pursue it. They could drop to pennies on the dollar. I mean, it could be truly spectacular, but you really have to have guts to take advantage of something like that.
Rick saw a split developing between basically the haves and the have-nots in this situation.
We've seen before that when the whole market gets whacked, everybody gets whacked. Everybody. There's no exceptions. Even the companies that have, absolutely great management teams, proven track records, excellent projects with 43101 compliant resources in the ground, much less discovery risk, lots of cash in the bank, everything that you really want in an insecure time, and they all get whacked. I mean, and it's happening right now. So I wouldn't disagree with Rick. What I would say is that everybody gets whacked, but the ones that really have the goods, we will see a divergence. If you recall, in 2008, everybody got whacked. Yeah. But for the companies that actually had the goods, right, when they became real value plays and everybody could see it was overdone, the market turned around. Gold was the first thing to turn around. There was no U-type bottom. It was a sharp V, and gold came screaming back, even by the end of 2008. And the quality companies came back in January 2009 and started heading up again, earlier than the rest of the market. I would expect something like that. If we have a broader panic, what Rick likes to call market capitulation, if we see real market capitulation, where people just give up in disgust, people will sell at any price, everybody will get whacked. But that will be a spectacular opportunity. And the companies, the haves, as you put it, they should be the ones to come back first and strong.
Yeah. Is it possible at a show like the PDAC, with 1,000 exhibitors, to pick out the haves from the have-nots?
It's very difficult for the average investor to go through. I mean, these guys are salesmen. Their job is to make sure that you come away from their booth feeling like you've just discovered the next best thing since sliced bread. And most of them are very good at it. So it is kind of a tall order. But if you know what you're doing, and I'm not just saying, trust me, I'm the expert, I can do this for you.
Louis, I trust you because you're the expert.
But no, you can educate yourself. You can ask hard questions. I mean, you can look the guy in the eye and ask him, in this market, how much money do you have in the bank? Is that enough for you to deliver the next milestones? I mean, these are not rocket science questions. And if the guy suddenly is looking at his shoes or, look at the time, got to go, that's a good answer. I mean, good in terms of telling you what you need to know, not a good answer from the guy.
Let's talk about the other big story. The Dow Jones over the last 5 years, a new high. It's up 20% over what it was 5 years ago. Meanwhile, back in Toronto, in the real world on the venture exchange, it's back to exactly where it was 5 years ago.
Yeah, well, that certainly reflects the market sentiments. And, first and foremost, you got to say, okay, the Dow is up 20%. What's the dollar? Over the same time period, I think you're actually looking in real dollars. You're looking at a loss, but that only makes the TSX worse. We could talk a lot about this. It could quickly become to appear something like a religious debate or a philosophical debate. I really don't want to go there. I would just say we don't agree. We think the market optimism is extremely ill-placed. The house of cards is as shaky as ever. The things the governments of the world have been doing to try to fix the economic problems have only exacerbated them. Sure, you inject a lot of new money into the system, and at first it feels good. It's like a stimulant in a patient with an open wound. At first, the stimulant makes things feel good, but you're pumping the blood out the wound faster. It's not going to help in the long run.
I guess the question I'm asking is, did that affect at all the mood at the PDAC, or were they focused on more important things?
I don't think that was directly relevant, because on the one hand, you might say, well, if the economy is doing better, or people think it's doing better, well, that's bearish for gold, right? Gold should go down, gold stocks, gold mining companies, fine. But if the same thing, the economic optimism is there, that means your copper should be going up, and your nickel and your aluminum and all these other minerals and extractive resources that Canada is known for. So it really net should not have whacked the TSX as a whole. There is, I think, a separate thing going on. There is, I wouldn't yet call it market capitulation, but there is a fear and a distrust of the resource sector. People don't understand why the mining companies have underperformed over the time when the underlying commodities have risen, prices of metals have risen, but the companies haven't been doing so well. And there's just, I think, a lot of people giving up, saying, I don't understand this. This isn't doing what I think it should. It's too risky. I'm out of here.
Let's move away for a second from consumer sentiment and talk about what's actually going on the technical side with some of the mining companies. Some of the people at the PDAC talking about concerns about lower grades, decrease in drilling, decline in new discoveries. Those are kind of key factors, are they not?
Yeah, they are. And again, quoting our mutual friend Rick, low prices is the cure for low prices, right? So
true enough.
If there's trouble in mining, that only means that the people who have successful projects will be that much more successful. I think one of the issues, though, has been really blown out of proportion or misunderstood. There's a great skepticism of big bulk tonnage projects out there, low-grade projects. But the reality is that the high-grade projects of any significant size are extremely few and far between, and getting even more farther in between with every passing year. The low-hanging fruit has all been picked. It's extremely rare to find something like, Pretium Resources, high-grade and giant deposit up there in British Columbia. That's really only happened twice in the last 10 years, the other one being Aurelian. It just doesn't happen. And the mining companies, the big ones, they have to replace 5-10 million ounces a year of production. You can't do that with little high-grade deposits. So you need big bulk tonnage deposits. The big bulk tonnage mining is not going away. Costs need to be controlled, yes, and they will be, one way or the other. If they're not, production will decrease, prices will rise, and that will justify the new projects that can do a better job. But actually, I don't expect that to happen wholesale. I think we will see prices improving, and that will drive margins. And, we go forward from there. But this skepticism of bulk tonnage deposits as large, it's, again, baby in the bathwater. You can't write off the big bulk tonnage deposits. They really are the future of mining.
Louis James, our guest here on This Week in Money. Great story in the Wall Street Journal blog. They're also at the PDAC, something I had not thought about for miners. A shortage, Louis, of young geologists and engineers. You must see this. The current crews at the mine sites are older. That's driving mining costs up.
That's actually last year's story. They're a little bit behind the curve here. It is absolutely true. And you would go to mining association meetings, say, 5 years ago, and I would be the only guy in a room of a couple hundred people with black hair.
Yeah.
It's just the way it was. And there were mining engineering schools and mineral economic mining geology programs shutting down all around the world. There just weren't people interested in going out and learning how to rape the earth. If they became a geologist, they wanted to save the planet.
Yeah.
Nowadays, people actually want jobs that pay. And so enrollment in the universities has really turned around. Several programs I've heard, enrollments are doubling and tripling. Of course, that's from such a low number. If you had 2 students before, you can triple your enrollment and still not have that many students. But I do understand that has begun to turn around. The economic realities are percolating into people's minds. And we are starting to see more young people. But this is a different kind of danger. What we're seeing now is we've got a lot of seasoned veterans out there and a lot of very young people. And the veterans are, retiring, and fewer and farther between. The danger is that you can have companies with a bunch of young bucks that really, they know what they're doing in theory. They're not ignorant. They're not stupid. They're good people, but they just don't have the experience that the older guys do. That is a serious concern. And as an investor, I want to know who's doing the technical work. This is one of the reasons why I put my boots on and go out and check out the projects. I don't just read the website. I go look.
Yeah.
And I want to know, who is doing this? Who's sitting on the drill rig and looking at that core coming out of the ground?
So sum up what you learned at this year's PDAC, beside the fact that Toronto was not a fun place to be this time of year.
Well, actually, it was snowing, but it was sunny. It wasn't so bad.
And you were mostly inside, right? So.
Yeah, I would say that what I learned wasn't really so much from the PDAC. What I learned of greatest value was in the individual meetings that I had. I found some interesting deals. I think there will be forthcoming recommendations based on what I discovered. As a broad PDAC comment, I would say there were a lot of people there, but I'm not sure there were that many buyers there.
Yeah.
I mean, it was very busy. There were bodies all over the place. But a large number of governments had booths there, and they, of course, brought large delegations that were wandering around looking on old companies. That's not the same as enthusiastic investor participation. So it was a big, busy PDAC, but perhaps a bit on the grim side.
Long term, are you optimistic?
Oh, absolutely, absolutely. My great fear is very short term, and the fear is not that the market will go down. Actually, I think the odds are good that it will before it goes back up. My fear is that people will panic and sell low after having bought higher a year ago or more, and they get so disgusted that they lose out on the opportunities ahead.
Louis, always a pleasure to talk to you, and as I'm sure our listeners do, appreciate your insights. Thank you, sir.
Sure thing. Thank you very much.
After the break, Sean Brodrick on This Week in Money.
He Touched Me, the Gospel Show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is editor of Red Hot Global Resources and Global Resource Hunter from Weiss Research. Check out Sean's blog at uncommonwisdomdaily.com. Hey, Sean, it's always good to have you back on This Week in Money.
Always good to talk to you, Phil.
Dow hit another all-time high this week, but kind of a so-so week for gold, moving sideways. The real story, the opportunity opening up in gold and the gold miners. Over at stockhouse.com, Sean, they're calling the TSX venture a zombie wasteland.
That's been the general mood for the last 6 months, ever since John Kaiser came out with his view that a bunch of stocks were going away. And he's not the only one. There are other people, Eric Sprott, also saying the same thing, that between 600 and 1,000 stocks will go away within the next year. I have to tell you, though, there were very few no-shows at the PDAC. Even companies I know that don't have two dimes to rub together showed up there. So I'm not sure when they're going to fold their tents. Maybe if they don't get the deals they were looking for at the PDAC. And the general mood that I was understanding was that there was a lack of institutional traffic that had some miners in kind of a funk. But many of the miners that I spoke to up there, I mean, they have plenty of money to drill, to work on their projects there. They have enough money to keep going for at least a year or two. So I know there are miners who don't have much money, but most of the ones I talked to were actually doing pretty good.
Now, for folks who have not been to the PDAC, not familiar with what it is, it's Canada's largest mining show, probably one of the biggest ones in the world. A lot of folks there. What was the mood like this year?
Many people were disappointed about the lack of financing deals and stuff like that. That is, people in the business. But there was plenty of retail traffic. Okay. Certainly there were plenty of people going through there looking for bargains, and I think they're finding them. I would say that the people who were running the companies, they weren't glum, but they were kind of soldiering on because they're really ready for this whole thing to be over with. Maybe if we do get the washout that some people are talking about, that would be good for the business in a way. Then again, the proof is in the pudding. I'm hearing all these people saying all these companies will disappear.
Yeah.
They've been working on that for 6 months. We haven't seen them go away yet. So maybe people are able to get funding through other means. I don't know. I think it's a great time to actually be a streaming company. That is a company that gives a project money up front so that project can be built in return for a share of the silver or gold that comes out of that project.
I guess Silver Wheaton is the most prominent example of that,
Silver Wheaton
right?
is absolutely the most prominent. Royal Gold, Franco-Nevada, Sandstorm. I think that they will see some great deals come on the table simply because other financing has really dried up. Companies that maybe would not have wanted to stream in the past may not have another option in order to build their mine. So I think that we could see those streaming companies really come out of this looking very, very good.
Check out Sean's terrific post at uncommonwisdomdaily.com. Greed, Blood, and Gold, Canada's Great Gold Rush. Some terrific history there that can teach us a lot of stuff about what's going on today and the future. Some of the lessons, what are some of the takeaways we can learn here from history?
First of all, Canada has some amazing history. I mean, when I was researching this stuff, you've had multiple precious metal booms, and it just teaches you things about not to put all your eggs in one basket, to be careful, to know when to walk away, just to realize that every boom is followed by a bust, and so that's like one of the things that you just have to be prepared for. And so when the game is late, not to start putting all your money into it, because this is when the smart money actually takes their money off the table. Mm-hmm. That said, I don't think we're in the end game for gold or silver. I think this is kind of a intermission. We have seen other corrections in gold and silver percentage-wise that were much steeper than the one we're seeing now. This percentage-wise, it's not that really big of a deal. It's a long one. I mean, it's really been lasting a while, but a lot of that, I think, has to do with the way that the central banks have really been kind of pushing the economies around, and so things get a little distorted because of that. But from all I can see, it's still a correction. There's still a lot of stuff that could work out extremely well, and I'm seeing some incredible values out there. One company we just added to Global Resource Hunter today, and if anyone is one of my subscribers and they're listening to this, be sure to check your email because I've been sending you guys some great picks. Anyway, the one that we sent to them today, they were planning to double their production from 2012 to 2014, and then over the next 2 years, they were going to actually double their production again. And yet this is a miner that is so cheap, it's amazing. Mm-hmm. It's amazing what you can buy these things for. And another miner we recommended, I mean, it's a great miner working down in Mexico, growing its resource, working on bringing another project online. It has plenty of silver coming out of the place where it has been really working for years. So this is a miner that knows how to successfully bring new projects to mine. And it has done this before. The thing touched $1 a share, and it's just amazing. I mean, amazing to me how cheap these things are. So that's why I have started making recommendations. I mean, it might not be the bottom, but it's at the point where the mining industry, especially precious metals, is so hated right now.
Yeah.
Just hated by investors that you can find some amazing deals, not of explorers, not of developers, but believe me, those are really cheap, but of actual producing miners. And just the discounts they are trading at is just mind-blowing. So I think it's a great time to put money to work because these companies are not going away. I don't care if gold goes down to $1,000. Mm-hmm. These companies will still make money. And many other projects are not being put into production because of the crisis that's going on in the financing arena right now. And also, if say gold did go down to $1,000 an ounce, I do not think that's happening, but I know people have these nightmares where they say, what if that happens? Well, what if it did? The miners that I'm buying will still stay in business. Other miners, really big miners, mm-hmm. will not. So that's just some real profit potential for these companies if there's a real crisis. That's why I want to own them, because I think that they really stand to just really come out extraordinarily well on the other side of this whole mess.
Sean, tell me how Global Resource Hunter works. How can that help me make the right decisions?
Well, it can help you in many ways. Global Resource Hunter isn't just about precious metals. That's often one thing people get wrong, because often when I'm here on, speaking to you on your show, we speak about precious metals, but I like natural resources of all types. I like oil, gas, agriculture, infrastructure. I mean, it just doesn't have to be natural resources. I am looking for things that will really ride the big wave we are seeing of like urbanization and also industrialization in the emerging markets. For example, they're expecting another 300 million people in like India to move to the cities in the next 10 years. They're expecting something like twice that many in China to move to the cities in like the next 10 years. Urbanization. These people are moving from a fairly agrarian, rural environment where they didn't have much to an environment where they want cars and refrigerators and apartments and all the stuff that goes in there, dishwashers, you name it. And so that's really going to continue to drive this whole rise in all these things.
Okay.
And then we get to things like energy. You know, I've been talking about Saudi America, which is the U.S., Canada, and like Mexico.
Yeah.
We are going to become together like probably the premier energy superpower of the 21st century. And so there's just so much money to be made there. And in those companies that can make money off things like cheap natural gas, I expect the price of natural gas will go up, but it's not going to go up a lot. And so those companies that are using it to make products in the U.S., in Canada, they can make a tremendous amount of money. So these are the kind of investments that I look at. And I also like nice dividends because I like owning a stock that pays me. I mean, that to me is like, that's my favorite thing. You can't get that in like miners very much, but you can certainly get it in pipeline companies, natural gas storage firms, agriculture companies, stuff like that. There's all sorts of stuff like that. So those are the kinds of things that I'm looking at. It's been working out very well for us, at least for the first part of this year. Then again, we're in a bull market, which I have fights with people at work about that all the time. I do work with a big bunch of bears.
Sure.
And of course, they think that it's all a house of cards that's going to come crashing down. Me, I look at it and I think that we are still coming out of a recession. And so growth potential is there. There's some really good potential in the economy and in the markets. We have seen the price-to-earnings ratio of stocks go up, and so it's not as cheap as it was, but we also just had a big breakout in the markets recently. And if history is a guide, after that happens, after we have a big breakout like we just saw, usually the markets gain, on average, about 8% in the next year. And since we just had a big recession and stuff, I think we could gain more than that. So we'll see how it goes. Certainly this is a time when, the picture of the future is quite cloudy for many of us, including me. So I like value. I like stocks that pay me. I like tangible things, gold, silver, oil, natural gas, agriculture, the like things I know people are going to need, especially as the emerging markets become more like us. And they want all those shiny things and all that food and all that stuff. And as North America becomes the energy superpower of the 21st century, those are the big trends that I'm riding.
Check out Global Resource Hunter and Sean's blog at uncommonwisdomdaily.com. You can also find Sean on Twitter at Sean Brodrick. Hey, Sean, thanks for this.
Phil, it's always great to speak to you. Thanks very much for calling.
Thanks to our guests, Rick Rule, Louis James, and Sean Brodrick. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.